Welcome to the Big Picture Retirement Show, where you'll learn what it really takes to have a successful retirement. With over 20 years of experience, your host, Rick Rivera of Safeguard Investment Advisory Group, has seen it all and is here to help you achieve your retirement dreams. This is the Big Picture Retirement Show.
Well, hello, everyone. Once again, this is the Big Picture Retirement Show. I'm your host, Rick Rivera. Those of you that are new listeners to the Big Picture Retirement Show, we actually talk about ideas, strategies, give you tools in which you can implement in order to enhance what it is that you're doing when it comes to your retirement planning. Maybe you're listening to the show, maybe you're 5 years away from retirement. Maybe you are already retired. Well, we're going to give you tools and strategies each and every week that are going to enhance those things. And again, what we do here is focus on the things that we can control, minimize the effects on the things that are out of our control when it comes to your retirement planning. So today, what I want to discuss is basically looking beyond the surface when it comes to investing. And what I mean by that is just to kind of give you a general idea. So many times I hear individuals, they're talking to neighbors, friends, family members from time to time about investments. And, you hear your friend or your family member is, working with the broker, or maybe they're doing their own investing and they're making X percentage. Do you hear that? Oh, I'm making, 8% on my money or 10% on my money or 15%, whatever the return is. And you're not making quite that return. So of course, you want to jump on it. And so many times I hear people saying, or they even call into the show, hey, Rick, my neighbor tells me he's working with some guy and he made 12% on his money. And, I'm thinking about switching brokers because this, my neighbor's doing so well. And, I want to jump in on the bandwagon. And here's the thing, folks. Of course, when it comes to retirement planning, investment planning, period, return is very important. No question about it. But I want to give you some things to look at before you make that jump. Some things that you should be considering outside the just return alone when it comes to your investments. Because again, so many times I hear not only what I was just mentioning previously, but people say, well, I heard, that I got a good tip or whatever. So what you need to look at, and again, the things I'm going to give you are things that you want to see. What you want to do is I want to give you some ideas, things that you can jot down right now where you can look under the hood, so to speak. You see the nice shiny car. It looks beautiful on the outside, just like that investment. Hey, my neighbor just told me, his broker made him 12%, this year on his money. So you see the nice shiny car, but then when you lift open the hood, you find out there's a bunch of cobwebs underneath there. You find out it's not what you were expecting. You open the door, you look in the interior, and you find out, there's, cracked leather and holes, and there's no radio, and there's no this, and there's no that. So what I'm going to try to do is let's not get caught up, again, on just return alone. And what I'm going to also be talking about later as well, the same could be about tax-free investments. Again, not just return, but again, the same scenario can go with a tax-free investment. So many times I hear people saying, oh, Rick, I talked to my neighbor, he's working with some guy. And again, they call into the show and they say, I'm going to go talk to my neighbor's friend because, he's getting tax-free income off his investments and I want to do the same thing. So I'm going to jump into that. So I'm going to talk on both sides of the equation. So let's first attack just, looking at things from a return standpoint and things that you should consider. Now, before I go into this, some of these things I'm going to share with you right now, I want you to understand that it's always important as disclosure. And I know I sound like a broken record, but it's so important that you sit down with a fiduciary, sit down with somebody who's a seasoned investment advisor that specializes in this area. So that way they can kind of help you scrub the list on what's most important to you. So let's say, you hear from your neighbor and they say, listen, my broker made me 12% or I made 12% on my investments or whatever the number is. And it sounds attractive. You're like, oh, great. I want to jump in on that. Well, one of the things that we got to take in consideration is what was the time period in which they made that rate of return? That could be critical because, for somebody to say, hey, listen, you know what? I made 12% rate of return on my money from, January to June, but the previous years, they've been down a negative 30. Maybe now this investment doesn't sound so good. The other thing that, we have to take into consideration is, okay, let's say you made 4 or 5% on your money and this person made 8%. 8 is always better than 4 or 5. But the other thing that needs to be taken into consideration is how much risk did this individual take in order to get that rate of return? So let me give you a quick example of things that, need to be taken into consideration. Let's suppose that, some neighbor says, hey, I made 10% on my money, and you're like, oh, darn it, I only made 7. And you compare both investments and you find out that the investment that made 10 had a standard deviation of 15%. In other words, the amount of volatility, the ups and downs, so it swung as much as 15%. So if you had $100,000 in there, there's times where your money was as low as $85,000 in it, where maybe the other investment that you have, let's say the one that made, the 7%, maybe that only had a 5% standard deviation. It only had about 5% risk in the standard deviation of the investment. So now the thing that you have to ask yourself is it worth me taking on 3 times the amount of risk in order to get an extra 3% rate of return? For some people, they may say, hey, listen, you know what? No, it's not. Because that 3% isn't going to change my lifestyle. But if I'm down 15% in my portfolio, I might lose a little sleep. Or that could have an effect on my retirement planning. Or maybe I'm close to retirement, and at this stage of the game, I've kind of already won the comfortable retirement. And if my portfolio drops 15%, that could have an effect on whether or not I retire this year or next year. So not only do we have to look at return, but we also have to look at level of risk, which is so important. Now, if you have questions about some of these things that I'm talking about, and again, in today's show, because the time goes so fast, I can't give you a full exhaustive list, but I'm going to give you some important things to consider. And maybe you have questions about this, or maybe you have questions about some of these things that I'm discussing regarding your own portfolio. Give us a call, toll free, 800-700-1980. Be happy to give you a 15-minute strategy phone call, and I can maybe answer some of these questions for you directly regarding your situation. Or maybe you just have a question outside of the topics that I'm discussing today regarding your retirement planning or your investment planning or taxes or whatever else you have going on, your pensions or Social Security. Either way, give us a call toll free, 800-700-1980. Again, that toll-free number is 800-700-1980. And if you're just tuning in, once again, you're listening to the Big Picture Retirement Show. I'm your host, Rick Rivera. What I'm going to do is I'm going to take a quick break. When we come back, I'm going to finish discussing some of the other things that you need to look at in investments when you're looking under the hood, so to speak. And we'll pick up where I left off.
You're listening to the Big Picture Retirement Show with Rick Rivera. For more information about Rick and the Safeguard Investment Advisory Group team, go to safeguardinvestment.com. While you're there, you can also download educational retirement guides and sign up for an upcoming seminar. That's safeguardinvestment.com. Now, back to the podcast.
And we're back. Again, you're listening to the Big Picture Retirement Show. I'm your host, Rick Rivera. Feel free to give us a call, toll free, 800-700-1980. If you have any questions about any of the topics that we're talking about on the show today, or maybe you got questions about things that I'm not covering today on the show. Maybe you got questions about your pensions. I know some people are getting buyouts right now and they're like, hey, what do I do? What's the most effective way for me to strategize this buyout that I'm getting? And you have questions about your specific situation. give us a call, toll free, 800-700-1980. I'll be happy to answer any of your questions personally, right over the phone and kind of get an idea of your overall scenario and let you know, maybe give you some tidbits of information that could help you directly. Also, we have a new brochure that we just came out with. Are you paying too much taxes in retirement? It's a great brochure because it's going to give you some good information to set you up now, give you some ideas of what you can do now before you retire to help minimize the taxation on your Social Security and taxes when you do retire. So if you care to take advantage of that information, give us a call, toll free, 800-700-1980. Give us your email address and we'll be happy to email that brochure to you. Or if you want, you can give us your mailing address and we can mail that to you directly. There's no cost or obligation whatsoever. Same thing with that 15-minute strategy call. If you want to call me directly, I'll be happy to open that up to you. I'll give you a 15-minute strategy call to answer any questions you have regarding your own personal situation. It could be regarding Social Security, pensions. Give us a call, toll-free, 800-700-1980. And then, of course, you can reach us on the web at safeguardinvestment.com. Again, that website address is safeguardinvestment.com. And again, you're listening to Rick Rivera on the Big Picture Retirement Show. So let me pick up where we left off. I was talking about things that you need to do in order to kind of look under the hood a little bit when you hear things from neighbors, friends, or other investors, or even, stockbrokers bragging about what returns they're getting for their clients and what have you. And what I was saying is, of course, return is important, but there's things that we need to look at under the hood, so to speak, to see if it makes sense for our situation. And one of the things that I said was, we need to say, if we have two investments, one that did, a 12% rate of return, the other one that did 7, or one that did 10, the other one did 7, one of the things that we need to take a look at is how much risk did that individual take in order to get that rate of return. And if the one that did 7% had a 5% standard deviation, the one that did 10% had a 15% standard deviation, or had more return at a higher standard, 3 times the amount of risk in it, then, you might say to yourself, well, listen, getting, 10% is nice, but that extra 3% is really not going to change my lifestyle. So maybe I prefer to be in something that has, 3 times less amount of risk, has much less risk, maybe not quite getting that rate of return, but allows me to sleep a little bit better at night. And to be quite frank, I already won the comfortable retirement. So I don't need to take those kind of chances in the market because, if I make 5 or 6 or 7%, hey, that's more than enough for me. I maintain my standard of living. If I lose 15%, maybe that's going to change my standard of living, or maybe it's going to mess with my psyche alone knowing I lost that much money, or maybe that might have a difference between me retiring this year as opposed to next year or whatever. So we got to look at how much risk that this investment's taking. The other thing that we got to take a look at is diversification. Just because somebody made X amount of return on that investment, how diversified is that particular investment? Because, let's say, you have a broker that has you in a variety of different stocks, or you have a variety of different mutual funds. And when we delve down deep and we look under the hood and we find out that most of these investments are working virtually the same, or mainly in the, same industry, or bottom line, when investment A is going up, 10%, investment B is also going up 10%. But then when investment A is going down 10%, investment B is also going down 10% based on the same economic conditions. So if your diversified portfolio is truly not diversified, does that really make sense for you? And the other thing that I've seen that happens is maybe you have, instead of being overly correlated, maybe you have what's called negative correlation going on in the portfolio, where one portion of the assets might be going up 10%, the other portion of the assets are going down 10%. And then when the other portion decides it's going to go up 10%, the other half is going the opposite way. So now you got your investments working opposite each other because you got the 401k invested one way, you have your other investments, invested another way. Nobody's really talking to each other. They're working opposite each other, so you're not making any money in between, and you're still paying your fees on all these investments. So you're actually losing money. So we got to look at risk. We got to look at how diversified the portfolio is. The other thing that we want to make sure is, just because they tell you, hey, you know what, we made X percentage rate of return. Again, the other thing I said at the beginning is, well, over what time period? Because let me just, give you a quick example. Let's say somebody made a 2% this month on their investments. Let's say somebody put in 100 grand and they made 2% on their investment this month. They can say, well, 2%, that's a 24% annualized return. Gosh, how wouldn't you like to be in this investment? This investment, that I'm in has a 24% annualized return. Well, yeah, but the problem is it didn't make 24% yet. Just because it made 2% this month, does it mean that it's going to make 2% next month and the following month, the month? Yeah. So again, it depends on how they're coming up with their percentage rates as well. Now, of course, an investment advisor that specializes in this area, that's a seasoned investment advisor, can help you with these things. So when you're getting information from your friend or getting information from a broker and they're touting returns and you're just like, hey, I need maybe a second opinion on this. I mean, it sounds good, but let me just make sure it fits my situation. We can help you with that. Give us a call, toll free, 800-700-1980. I'll be happy to give you a 15-minute strategy call, let you know what you need to be looking at. Also, if you want to download that new brochure that we just came up with, it's called Are You Paying Too Much Taxes in Your Retirement? Give us a call, toll free, 800-700-1980, and our staff will go ahead and get that emailed to you. Or if you prefer, we can also mail it to you as well. But you got to give us a call, toll free, 800-700-1980. The other thing that needs to be taken into consideration here, again, in looking under the hood, because again, so many people, so many advisors are so busy chasing return in the market because they know that's what you want to hear is return, that they lose sight of the things that they can actually control. And what do I mean by that? Well, what good is it, again, under that same scenario, somebody brag about their rate of return over something that, again, we have no control over, because at the end of the day, nobody can actually tell you what the markets are going to do next year. Nobody's going to tell you what CD rates are going to be. Nobody can predict. All they can do is give you their best educational guess. So if you can save 10 or 15% in taxes, how easy is it to make that same amount of money in the market? So many advisors are so busy chasing return in the market that they lose sight of the things that they can control. So this is going to bring me to another topic, which is along the same lines about looking under the hood. So occasionally, we'll get people that call into a show and say, hey, Rick, a friend of mine's working with this broker and, the investments he's got him in, he's got him in these tax-free bonds and he's getting tax-free income. And I'm going to, jump into that because, that sounds great to me. Well, here's the thing, folks. It's great to get tax-free income off the investments. But once again, looking at things from the opposite side of the equation, we have to look at your scenario specifically. Because your friend, let's assume he's in a 40% tax bracket, having those tax-free bonds may make sense. So what we have to do is we have to compare the return on a taxable investment to the non-taxable investment for you under your specific situation. And how do we do that? We have to look at your taxes. We have to look at your income. We have to look at your expenses. And we do an analysis. And, if the taxable investment produces 4, for example, and after taxes, based upon your tax situation, you end up with 3.5 or 3.25%, but yet a tax-free bond is paying you 2. Well, in this particular case, you're better off in a taxable investment because based upon your current tax bracket, net in your pocket after taxes more than what the tax-free investment is paying you. So it has to make sense. It may make sense for your buddy. It may make sense for somebody else, but it may not make sense for you. The same thing goes with tax-deferred investments. I can't tell you how many people I run into that are paying fees on investments for the privilege of tax deferral. But when I look at their tax bracket, when I look at their tax return, the fees are not justifying the tax savings. So now they're cutting off their nose to spite their face. So when I asked them, hey, has your advisor or whoever put you into these investments, did they run a mock tax return for you or, reviewed your taxes before they put you in the investments? Of course, the answer is usually always no. They just said, hey, I can put you in these investments and this money will come out to you tax-free, or this money will grow tax-deferred for you. And they tell you all the wonderful things about it, but they never do a deep dive to see if all these wonderful things are going to pertain to you. And now you're paying fees on something that you're not using, which is now eating into your return. So this is why it's so important that you have to look at these things from that big picture approach. We have to look much deeper under the hood. So the best advice I can give you, whether you hear on the street somebody talking about a great rate of return that they had, or a great investment that's minimizing their taxes, or something else. I mean, these are just two simple examples, but it could be something else, whatever it is. That's fine. That's dandy. Of course, look into it. They are the hottest stock tip, whatever it is. But make sure you look under that hood. Do not be afraid to look under that hood. Maybe you're in a situation where you're like, well, Rick, I don't even know what questions I should be asking. Well, if you need help with that, give me a call, toll-free, 800-700-1980. I'll help you with some of those questions, give you some tidbits on things that you should be looking at. And again, maybe it's something outside of what we're talking about here today. Maybe it has to do with a current buyout that you're getting from your employer, or maybe it has to do with your pensions or Social Security or taxes or any of these topics. Give us a call, toll-free, 800-700-1980. Our staff will be happy to schedule a 15-minute strategy call with me personally. Again, you're listening to the Big Picture Retirement Show. I'm your host, Rick Rivera. Unfortunately, that brings us to the end of this show. I look forward to talking to all of you next week. But real quick, if you care to get that brochure that I was talking about earlier downloaded, which talks about, are you paying too much taxes in your retirement? This is going to be good for you whether you are currently retired or maybe you're not retired. It's going to give you some great information on strategies and things you can use in order to minimize taxation on yourself when you do retire. So if you want help with any of that, give us a call, toll-free, 800-700-1980. You can also reach us on the web at safeguardinvestment.com. I want to thank all of you for listening today. Have a great weekend, and I'll talk to you next week.
Firm offers insurance services. Safeguard Investment Advisory Group, LLC is a registered investment advisory firm. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Safeguard Investment Advisory Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Safeguard Investment Advisory Group, LLC. This radio show is a paid placement.